So welcome to the Mailbox Money Show. I am Bronson Hill. I'm here with a friend, Pancham Gupta. Excited to have you today, Pancham. He is the head of Mesos Capital, and he has an IT background. Now they have a large portfolio of multifamily apartments in North Carolina and Florida, and he does some really unique things both in the way he markets and his podcast, as well as just the way that he manages the assets that he works with. So really excited to have you here today, Pancham. How are you?
I am doing awesome. Thank you for having me, Bronson. I'm really excited to be here.
Awesome. Really glad to have you. So give us a little overview, Pancham, about your background and kind of how you got where you are now. And you have some really fun story in the middle of that too, about how you switched from one career to another. So I want you to kind of get into all that.
Sure. So I'll give you a quick run of it. Like, I came to the US in 2003 to get my master's degree in computer science. The idea at that time was that I'll get my degree and then go back to India, where I'm from originally, and do something of my own back there. And, I'll get my work experience for a few years and then go back. So, in 2009 and 10, we actually decided that we're going to go back. Me and my wife, we sold all of our furniture. Only bed was remaining. And then we found out that, we were expecting a baby. And we said, okay, you know what? It's hard to move cities or houses, leave alone the countries. So we decided, okay, you know what, we'll have our firstborn here, and then we'll see, and then we'll go back. And believe it or not, in 2011 and 12, we decided that we're staying here and we're calling this country our home. And rest is history. And that's when I started investing in this country. I picked up that purple book, which I'm sure many of your listeners have read, is the Rich Dad Poor Dad and the Cashflow Quadrant, and learned how people on the left side, which is employed or self-employed, work for money and have control only 10% of the wealth, and people on the right side control 90% of the wealth, and they do not work for money. Their money works for them. So, and they actually control what people on the left side do. So, I decided that, I want to be on the right side. Didn't know how, and started investing in real estate. I, bought a single family home, second single family home, bought all these homes before I bought my own house, and slowly expanded into 5 different states. Slowly, and realized that it's not scalable at all. I had a full-time job, really good career, in finance in New York City. And, when the calls started coming in during lunchtime, there was no times, and I would just allocate my lunchtime to go and take these calls, or have scheduled some meetings, block my calendars for certain times. So I decided that it's not scalable, but I was really enjoying what I was doing. So I decided I want to do this full time, and started learning about how to scale it, and came across syndications, how to syndicate properties. So learned about that, started listening to a lot of podcasts like yours, and started going to conferences. We met at a bunch of them, and learned about syndication, and that's how I got into this. And in 2017, I actually quit I actually did my first syndication. In 2019, I quit my job to do this full time. So that's the long and short of it.
Yeah, you have I like your story a lot, because you kind of, obviously you came here to go to school, and then you stayed, and then you basically kind of continue to adapt and change. And I think a lot of people that are active in real estate or multifamily, or even do single family, some of our listeners do single family, once you get a certain portfolio, it gets to be really hard to manage while you're doing both. And your story is actually somewhat similar to mine, where I had a great corporate job, and I was working, and I was getting paid really well to not do a lot of work. It sounds like you were working a lot harder than I was, but I was doing a lot of real estate stuff on the side. But I realized that the time is really more valuable than the money. And if you can do things that are of higher value, it'll make more long-term. And so multifamily is really a big long-term play. But I really like, I know we've kind of talked about this before, Pancham, but when you were ready to leave your job, that was a difficult decision for you, because like you said, you enjoyed it, and your family had opinions on that. And can you walk us through that process? And I think you even got some outside help involved. Can you just kind of talk to it? I just think it's a really cool story about how you went about that.
Absolutely. So, I had a really high paying job in New York City. So we call that golden handcuffs, right? I enjoyed my job. It was not, I did computer science. It was nothing against the job that I did not like. It's just that working for that money part was something that I did not enjoy. And I also really started enjoying this real estate career on the side that I had. So when I made that decision that I want to quit my job, I talked to my family. I talked to my family in India, my wife, everyone, every single person was against it. The reason was that I was making really good money, and they were like, okay, you have this great job, amazing health benefits. We don't have to pay out of pocket for anything. We had this lawyer plan, there was this plan, there's so many different plans that our employer offered, that we pretty much had so many perks, right? And my wife would say, okay, what about the health insurance? My parents would say, okay, what if you don't make it, right? And my response to all of this was, what if it does work, right? Instead of talking about the negative, let's talk about the positive. But nevertheless, it was really hard for me because of all that negativity, right? That I was surrounded with. And I do not blame them. They actually really cared, because people, when they care about you, they feel scared that you can get hurt really bad. So nothing to blame them about. Then I actually hired a full-time coach. I decided I want to hire a mindset coach. And it's a funny story. I actually went to my wife one day when I made that decision. You know what? I want to hire a mindset coach to get myself out of my own head, so that I can quit the job. So I go to my wife and said, you know what? I actually decided to hire a mindset coach to help me quit my job. She's like, to do what? I'm like, to help me quit my job. She's like, just go quit. Why do you have to pay someone some money to help you find out how to not make money? And go quit. And why do you have to pay someone to do that? I'm like, I've been thinking about this for so long. I wish it was that easy, and it's not that easy. And that's why I want to get out of my own head. And I actually hired a coach to help me really get over all the programming that I had in my head to get away from the full-time job. So
yeah, the story is really fascinating, Pancham. I love it. And I love that, like you said, your wife's like, why do you, just quit your job? Why do you need to? But it is really hard. I had a very similar experience where I didn't hire a coach, but a lot of my family, it's a lot of educators and a lot of professionals, and nobody's an entrepreneur. It's, it's really nobody. And so when they're like, why would you leave your job? You're making great money and you're not working that much. And it's very similar to what you're saying. And there's a book by Robert Kiyosaki for anybody that's considering leaving their job. It's called Before You Quit Your Job. So it's a great title, but it basically talks about when you're an entrepreneur, when you're an employee, you get, the goal is to not make mistakes. If you make too many mistakes, you get fired. But being an entrepreneur, you have to make a lot of mistakes. And as you make mistakes, you have to learn very quickly. And so he says it's almost like jumping out of an airplane without a parachute and trying to assemble one on the way down before you hit the ground. And so it can be an exciting and terrifying experience. I know you talked about the golden handcuffs, and we don't have the golden handcuffs podcast that you're doing. We've got the gold collar investor. So I'm really glad you kind of went a whole different route, which is awesome.
Yeah, no, I'll add to one thing that what Robert Kiyosaki said, right? Like building the parachute on the way down. And he also talks about in entrepreneurship, right? In business, we have to work in teams. Like it's a team sport, right? Whatever you're doing. And in school, it's called cheating. So, like if you work with someone and, you do your exam, that's called cheating, right? So it's very different world when it comes to entrepreneurship. It's, it's a totally different mindset, and it's very hard to get out of your own head, especially for people who've spent long time in their full-time jobs.
Yeah, it is. And I think it's important because a lot of people that I'm sure are listening, may want to leave their job someday. And we talk a lot about passive income, and it's actually pretty related because, developing, really what is the right time to leave your job? That's something that I wrestle with. How much income do you need? How much passive? How much all this stuff? So it's a great conversation to get into. So let's talk a little bit about you with multifamily. Now you've got a large multifamily portfolio. Can you talk a little bit about, and you're also an operator, so you not only raise money, but you operate. So talk a little bit about your portfolio, what your approach is, what you like doing, maybe some of the markets that you're in. Just talk a little bit about your business.
Sure. So we are focused in the Carolinas and Florida mainly, where we are, finding value add multifamily deals. And it's hard to find those these days, but that's our focus. And our portfolio is about $100 million in assets under management, and we've done about eight, or actually we are under contract on our ninth syndication right now, and we've gone full cycle on two and going full cycle on the third one. So our focus really is on getting we have a very set criteria on which markets we want to pick, and we can go over that if you want, like what kind of criteria we have. We look at overall job population, job diversity, where the millennials are moving in, where builders are developing, where airlines are adding the segments to to those cities, and where U-Haul and United Van Lines are getting rented as one-way rentals, where those cities are the destination. So those are some of the cities that we pick, and some of those cities in Carolinas are like Raleigh, Charlotte, and Wilmington. That's our criteria, and so we are really focused on 100 plus units built after 1985 in those areas, those cities, and there has to be some kind of value add component associated with them. And our business model is we go in, buy these, raise capital, execute our business plan, and then either sell it or refi it.
Right. That's great. I know you've had a couple exits as well, but that's a very similar approach that we and a lot of folks use, is the value add approach, looking for, and also looking at markets. I think a lot of people just kind of think, oh, I'm just going to buy wherever, which is true. But I think these, like the areas like the Carolinas and Florida and some of these areas, we kind of do Texas to Florida, where you see, population growth, job growth, income growth. You're looking at all this stuff. And I think it's just the idea that, when the tide rises, it lifts all the boats, right? So you don't even have to perform that well. You have to be in the right area with the right type of growth, which I think is huge. But why don't you talk to us a little bit about what you see kind of the advantages of multifamily investing for people that are unfamiliar with it? Maybe you can just kind of talk about some of the advantages that you see.
Yeah, sure. So, that question can be answered. I cannot answer that question without talking about real estate benefits, generally speaking. But, I have this acronym which I read somewhere. It's not mine. But, real estate investing is called an ideal investment, right? I'm not sure if you've heard of it. I.D.E.A.L. investment, and I'll explain that acronym. It's literally an ideal investment. So I stands for income, D stands for depreciation, E stands for equity, A stands for appreciation, and L stands for leverage. So real estate investing provides all of these benefits. So I is very simple to explain. Income, right? After you pay your debt, you have some income left over, right? And then D is depreciation. I'm sure a lot of your listeners know that generally real estate is a very good tax shelter when it comes to sheltering your passive income if you have a W-2 job, unless you're a real estate professional. So there's a great benefit on depreciation. And then E is the equity. That's the equity you're building over time as you pay down your mortgage. You're building slowly that equity. And imagine that if you have a fixed rate loan, you're actually paying down that equity using the dollar, which is less in value in 10 years from now, with the same payment, which is lowering your equity. And then A for appreciation. Like all of us know that real estate, especially after COVID in last 1 year, has gone up like crazy. But generally speaking, the long-term trend has been, it's been going up and up and up. Yeah, we have had a downturn of 2008, but if you really, that's where the difference between single family and multifamily comes into play big time, and we'll go over that. But so you have appreciation, and then finally leverage, right? There is no other investment where you can go out and go to the bank and ask for loan. 75% loan to go buy a stock or to go buy some other investment. It's only real estate which provides you that, and banks are okay with that because they know something which they wouldn't otherwise do in the other asset classes. So those are the real estate benefits. And then now going into multifamily specifically, right? The D part of this I.D.E.A.L is huge when it comes to multifamily because of bonus depreciation. There is something called, we can do cost segregation study. We can go into details of that, what that means. But basically, you can depreciate a lot more in the very first year of ownership, and that depreciation could be a lot more for multifamily buildings and commercial properties in general. But multifamily is a commercial when it comes to cost segregation study. So you get that depreciation, and then also in 2008 when which were the crisis which was based on housing. If you really look at all the multifamily as an asset class, the default rate was less than 1%. I don't remember exactly, but it is actually, if I recall it properly, it was even less than 0.1%. I don't know the exact number, but definitely less than 1%. So there is a reason for that. Instead of, when people lost homes, they wanted to go and rent houses, right? Wanted to go into a rental place, and that's a multifamily building. Their occupancy went up, even though the rents may have suffered for some time, but their occupancy went up. And similar situation we have now. There is a lot of housing shortage, right? And people want safe and sound housing, and multifamily provides that. So it's not going anywhere. And even if the downturn comes, you still have this rental income that's coming in, as long as you can hold the asset. Even though if it goes underwater in extreme scenarios, as long as you can service the debt, you can still hold it, and it can go up as the market turns.
Right. So, and that's great. I think a lot of people that are new to this, and I remember when I was new years ago, it kind of felt like, wow, this just sounds amazing. Like you mentioned all these I.D.E.A.L investments, leverage, and it's amazing how even with inflation, there's a hedge there with that as well. And so just there's so many upsides. We just did an interview recently where we had a panel with a guy named Rick Rule, who's a well-known guy who talks about metals and things. Cool. And he was talking about he'd done 25 to 30 years of passive investing in multifamily real estate. And he just said it's been phenomenal. The tax benefits, the growth, all this stuff. So it's awesome when you meet people that have been doing it for years and years and have just had a great result. And he's not necessarily a real estate guy. He's more of a commodities and other sorts of things, but to hear his take on it. So it really is the bread and butter, particularly of real estate. And I think everybody should consider being involved in multifamily. But I wanted to ask you, Pancham, a lot of people sometimes, hear something like, man, the returns sound so good. And it sounds a little too good to be true. So why don't you give us some of for people that are kind of new to this or curious, what are some of the risks or some of the things maybe new investors should be concerned about or be aware of when they're looking at, doing a deal or working with a new sponsor or something like that? Can you kind of speak to that?
Sure. So I always answer this question in three ways, right? Like there are three very high level categories in terms of the risk that people need to consider, right? Number one is the market risk, where I can divide that into two categories: broader market and the sub-market where the property is located. Number two is the team risk, which is the asset management team, the sponsorship team, right? And number three is the asset risk, which is the asset itself, right? So we can go over I'll quickly go over these three separate risks. Like if you're a new investor, you need to think about overall market risk and the sub-market risk. Where is this particular property located? You cannot do much about the overall market. If the overall market, the financial environment tanks, it tanks for everybody. Like there is not even one person out there who would not get impacted by that. But it's basically, how are you hedging that, right? That, are you in a market which was not growing before, and and it's going to get impacted even more. So if you really look at 2008 and by 2012 and 2020 and 2021, the markets which were really good, like Dallas Fort Worth or Raleigh, Charlotte, they definitely, all of these markets took a dip in 2008, but they were the first ones to come back up, when the markets went up, right? So yeah, you hedge your overall market risk by going into markets which are growing, like we talked about that just earlier in the podcast. And then the sub market, you have to figure out within that market, are you in an area which is growing, right? Like how's the area median income within that sub market, right? If it is, we have a criteria of we don't buy anything which has an average rent of lower than $750 per unit. So, and we kind of have this formula of 3 times the rent should be your income, right? So that comes down to be around 40 to 45,000 area median, like the household income has to be at least that much, right, for a good safe blue collar neighborhood. So you have to look at that sub market as a risk. And then second is the team. Yeah, you have to, this is where this becomes really subjective, right? You have to have the trust in the team. And I get this question, how do you build that trust if you are a first time investor? And the answer is that it is not easy. You have to really talk to the sponsors, get on their list, get on the phone with them, maybe go meet them, maybe go check out their existing properties, how they've done it, right? And do this, dance, I would call it, like dating, right? If you don't go marry someone right away on the first date, right? You go and spend some time and see how they are doing. It's a time consuming, very, very time consuming process, but that's the only way I know how you can really build trust. So that's the team risk. And then you have to see their track record, like how they've done, how, problems happen with everybody, right? But it's not about what happened to them, it's how they react to that, right? That's what matters. And you have to see if they had any kind of failure, but how did they come about that, right? If they say they have never had any failure, then I would say that is very rare, and you have to look into that. And 99% of the cases you have to run if they don't have any failures. So that's the team risk. And then finally the asset itself. So you have to see what the business plan is the sponsor has, and what kind of asset it is. So for example, if their business plan says that, oh, we want to increase the rents by $100, but you look at the asset itself, right? And it has old roofs. It's in an area which has a bad parking, like bad driveways, parking lot and all that. And they don't have in their plan to fix any of those, and they want to increase the rents. Yeah, maybe market validates that, but you have to see asset itself is if that supports that kind of rent growth within that area, right? And that's there are a lot of other things you can talk about it, like assets that are built in 1970s, they have cast iron pipes, right? So is there a risk around that? Like I know in Florida, cast iron pipes behave very differently than they behave in Carolinas, for example. Same thing goes with electric wiring, right? Like whether it's aluminum or copper, and do they have plans for that? So all that comes under the asset risk. So these are some of the things that I would say that they have to think about when it comes to risk. But out of all these three, I think the number 2, which is the team risk, is the most important thing. We all know from our corporate careers, if you have a great team and you have a bad project, that great team will work hard and make that bad project a good project. But if the team is not good and you give them a great project, they can run that project to ground. So it's really, really important to validate the team and the risk around that, the execution risk.
Right. Those are 3. I mean, you mentioned kind of all of it, right? So the deal, it's the market, it's the team, it's the actual deal itself, and they're all important. And like you said, I agree. I think the team is really, really important. Not the only factor, but definitely a really big factor. There's this term that talks about more than betting on there's like the horse, the jockey, and the track, or things like that. If you're going to bet on one, really bet on the jockey, especially if they have a track record. So it's really that's a big deal. So we're kind of getting toward the end of our time here, but I just wanted to ask you one more question, really about how do you see, and you don't have to go super in depth, but I mean, how do you see inflation or other lending or macroeconomics affecting multifamily?
That's a great question. We internally discussed that. I think we are personally seeing, as of right now, when Fed is saying that inflation is transitory, we are seeing, I'll give you example of properties that we were looking at, let's say 1 year ago to now. 1 year ago, certain properties, Class B properties, which were trading at $150,000 per door, for example, they're trading at 190 to 200,000 per door in great markets. So that's almost 33% increase in asset pricing. What has really changed? Nothing has changed when it comes to that asset. What has changed is the financial environment. When it comes to all this environment about this liquidity that is out there because of all the money printer going brrr, right? So I believe that the inflation is here to stay, especially if that $3.5 trillion bill, which is the infrastructure bill, but has very little to do with infrastructure. But regardless, that liquidity, when this comes down in the market, imagine what that's pretty much 10%, more than 10% of overall debt that we have. If that hits the market, that bill gets passed, oh, that $150,000 property per unit that went to 200, I don't know what the ceiling would be on that one, because there would be so much money that would be chasing these kind of properties.
Yeah, it's interesting. We're really in a time that inflation, they're saying it's transitory. It hasn't really, the public really hasn't caught up with, inflation may be here. And particularly if we do have some change in asset prices, or we have a recession where single family may go down, multifamily may a little bit, but usually cash flow or rents will rise with inflation because cost of ownership goes up. So sometimes it's a little different than single family, but obviously we don't know exactly what will happen. But the more money that's out there, the more everything costs. And so that's why these deals are amazing, because you get into long-term deals with typically long-term debt at a fixed rate, and so you're paying it off in future dollars that are worth less. So the debt is less valuable, and so you're paying it off with money that's worth less, and because of the inflation, the value just goes up. So that spread gets to be wider and wider, which is awesome.
And I have this. Sorry, go ahead. No, I have this argument that you mentioned that if let's say there's a downturn, right? So what happens in the downturn? People, it's sad, but people lose their jobs, for example, right? What happens when they lose their job? They lose their homes, for example, right? Where do they go when they lose their homes? They go out and find a property to rent. And usually multifamily apartments, the occupancy starts rising. So there's an argument to be made that, yeah, if there is a downturn, the occupancy will stay there. Yeah, prices may not go up, but you will be able to service your debt.
Right, absolutely. Yeah, it is a really safe asset class, at least historically what we've seen. Even in 2009, is something the government's even shown. They're going to try to help people to stay in their homes. So, Pancham, what's one resource that's helped you on your real estate journey, whether it's a book, an app, a website, a tool, or something that you use?
So I would say in terms of the book, I would go back to that book, Cashflow Quadrant. That really changed my mindset. And I am so big on that book. I did a full episode actually on my show to discuss that book. And I would say that's one thing that has really, really changed my mindset.
Yeah, I would agree. I'd say that book impacted me more than the original Purple book, The Rich Dad, Poor Dad. So if you're listening and you have not read either of those, Rich Dad, Poor Dad, or Cashflow Quadrant, I think I actually like Cashflow Quadrant better than Rich Dad, Poor Dad.
Yep.
So it just gives very practical things. And if you're an employee, there's things to be aware of and how to kind of move to another quadrant where you're an investor or you're a business owner. So there's some real positives there. So, well, Pancham, I just want to really honor you with your story, how you did whatever it takes. You've kind of done whatever it takes to really be successful in your multifamily career, and even in your career, being very diligent, having a great job, and even doing what you needed, knowing that you needed to make a move, and hiring a mindset coach to do that, which I think is a great step. And so sometimes hiring a coach to get to that next level is really, really important. So I just wanted to say well done on that. I know for all the value you bring to your investors and with your track record and everything that you've done. I just wanted to say well done for all that, and appreciate all the value you're bringing too with your podcast, The Gold Collar Investor. So what's one way that maybe people can get in touch with you if they want to reach out?
Sure. So they can email me at p@thegoldcollarinvestor.com. I am on LinkedIn, Facebook, everywhere. And if they want top 6 reasons to diversify outside of Wall Street, they can go and download an ebook, which is the goldcollarinvestor.com/download. So if they go there, they will get this ebook, which will have many other reasons, which I discussed, on this podcast, but on top of that, and also the alternatives that they have on top of like how to diversify. So they can check that out.
That's awesome. Well, Pancham, I really appreciate you joining us today, and really wish you the best in your continued expansion of your multifamily business there.
Thank you, man. Thank you for having me.
So this was a great interview with Pancham. He talked a lot about his career and his transition. And I know a lot of us, we have goals to be full-time real estate, or to not have to work, or to be able to work on your terms. And it really comes with having goals, and sometimes even hiring a coach, get somebody involved to help you to be able to do that. So if you're in a family that maybe you're not finding the support you need, it's not uncommon. Pancham, that's his story. That's my story as well. You can find outside mentors, you can find outside friends, or people who've kind of gone before to help you. So a few takeaways that I had is that term I.D.E.A.L that he mentioned, where he talks about multifamily, it's income, depreciation, equity, appreciation, and leverage. And I just love multifamily because it also provides an inflation hedge as well, with just so much money being printed. So we're in a time that is, I think it will look very different in 5 to 10 years as far as just the inflation expectations going forward and what that will look like as far as spending. So anyway, I hope you enjoyed this episode. I'd love to hear any feedback that you had from it, but I hope that look forward to the next episode, and I hope you have a wonderful, you really put this to practice and you really get a lot of value out of it. So feel free to reach out to Pancham or myself if we can be a service to you. So look forward to seeing you on the next episode.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.